started trading refined products for BP, and now he's the lead Asia Pacific analyst for Kpler, which has a platform that tracks the voyages of all those tankers, crude products, amounts across the globe. Victor Yang is senior editor at JLC Network Technology. That gives analysts analysis and reports on crude markets, products, chemicals in China, which of course is a big interest for the global oil markets. And we've got Peter McGuire. He's CEO of XM Australia. That's a broker that deals in not only in commodities, but things like Forex, currencies, and stocks as well. So he'll have a good view of kind of all the other financial issues that are contributing to commodities. So I wanted to give our panelists each a little bit of time to kick off with a little 2-minute intro. We've discussed a little bit some of the topics that we're going to talk about, which goes from immediate term things like the current OPEC cuts in place, how things will look when Saudi Arabia comes back into the market after their big shock cut. We're going to be looking at obviously supply and demand, how the Chinese refinery demand is stacking up and what that market is looking like. Prices, of course, will be an issue. We've got crude on a little bit of a tear recently, rising again today. And of course, we can't not talk about LNG prices, which are going very high in Asia, given the colder winter there. And then, of course, there's going to be some geopolitical changes as a new administration comes in the United States, and that's going to affect things in terms of relations in the Middle East, in terms of flows to Asia, and politics there. So we'll try to touch on that as well. So let's get to our speakers. I wanted to start with Peter, if you would go ahead and just give us your brief intro, please.
Well, good morning and greetings from Sydney, Australia. It's a lovely sunny afternoon here in Sydney, a long way from where everyone else is based. If I look back in reflection as far as 20, I thought it was we all know it was an extraordinary year, but I don't think anyone could have naturally written a script, and the rebound as far as every asset price nearly parabolic by the end of the year compared to what we experienced in March. And that trend over that 9 or 10 month period was nothing short of incredible. So as we roll into 21, I think very much the landscape is raw, it's unknown, and I think that there's many components that need to be considered where we sit this time next year. And I don't think 21 is going. I don't think it's going to be a year of little geopolitical tension. I think it's going to be a lot. I also think that there's going to be some unknown unknowns come into play that we're probably living through as we speak, and how they are transitioned to value and as far as production and naturally the demand. So I'm looking forward to 21 from the oil industry and certainly from the commodity side. And I think it's going to be a bumpy ride.
Okay, fantastic. Thanks for that intro, Peter. Let's go to Victor, if you could give us your opening thoughts, please.
Yes, good morning. Well, I'm in Guangzhou, China. Well, as Peter said, well, it has been an extraordinary year, in 2020. And now when we are looking ahead in 2021, we still see a lot of uncertainties. Well, but one of the upsides, China's economy is growing faster, this year. This is quite widely recognized. So demand from China is growing, probably about the same speed in last year, or maybe sometimes about the same speed. So, but global demand might not be, will not be back to the pre-pandemic level yet, not yet in 2021, or maybe, not in a few years. So there's still a lot of uncertainty as well. And the geopolitical tension too is a major issue. So we are looking at, a lot of, as Peter said, unknown. So we are not prepared for very soon recovery yet. I mean, in 2021, even if we had the vaccine as well, the vaccine progress has been slow. And say like even in China, well, it wouldn't be by June before massive, well, vaccination. So we are not saying that the demand will be back as soon as the vaccine is, well, is ready. So a lot is still to be found out. So that's my presentation.
Yeah, for sure. That's useful to put a focus on demand. As you say, global demand isn't back to where it was pre-pandemic. But one of the things that we were hearing last year is that Chinese demand has come roaring back. So we'll want to touch on that a little bit later with you, Victor, as well, to see what your views are on demand in China and whether that's going to be maintained as well. Kevin, why don't you lead us in with your opening thoughts, please?
Thank you very much. Actually, that's a very nice segue, following on from Victor's comments about demand, because I wanted to talk a little bit about supply. Peter made the comment a few moments ago about 2020 being an unprecedented year. It was in so many ways. I mean, obviously the pandemic, but also actually for the oil markets. If you look at what happened in terms of inventories, in terms of supply, in terms of flows, we saw patterns and levels of pattern that we'd never seen before. So the Chinese, for example, were up to importing, 11, 12 million barrels a day of crude in the middle of the year in response to very cheap pricing that we saw back in April and May. That led to very high inventory levels, and those inventory levels really are reflected around the world. We've seen the world stocking up as a result of that surplus of supply and the absence of demand. So it's going to be very interesting going into 2021 to see what the recovery is like. I mean, we're all dependent on a vaccine for a solution to the pandemic and some sort of easing of restrictions and travel and industrial activity and so on. But I think that's going to take a lot of time to actually filter through. So it will be the second half of the year, at least, before we really see a resumption in normal demand. Now, having said that, there's one other market, and you mentioned it yourself in the introduction, that I think is incredibly interesting at the moment, and that's LNG. And we've got a situation at the moment where we've got very cold weather in North Asia. Beijing, for example, has had colder temperatures, lower temperatures than they've seen in decades. It's been cold in Korea, it's been cold in Japan. It's obviously also cold in most of the Northern Hemisphere. And that's created immediate demand for LNG, for power generation. And we've got a situation where even though supply is relatively healthy, the operational difficulties of getting LNG into terminals and therefore into power generation plants have meant that there's been a spike in LNG prices. And we're at the high 30s per MMBTU, levels that we've never seen before. So I think, again, we've got a very interesting situation coming up around LNG. We've got an interesting situation coming up around products and crude demand as we go through the year. And I think it's going to create, like Peter said, a bumpy ride once again.
Yeah, I think that's interesting. I mean, who would have thought, looking at the LNG market a few months ago, that we would have had these huge prices? But I guess, as you point out there, it's not so much an issue of supply as it is kind of stickiness and bottlenecks in the supply chain. And we could probably talk about that a little bit later as well too, since you are covering a lot of the shipping and the shipping market, where that's going to be so important, particularly if we see any additional flare-ups in the Persian Gulf this year. They said the intro as well is already started off and shaping up to be a tough one with a couple incidents in the Gulf there. And at the moment, supply doesn't seem to be an issue, but maybe investment will be, and maybe that impacts supply later on down the road. So we'll talk about that as well. Vandana, why don't you tell us what you're thinking about today?
Thanks, Anthony, and a very good afternoon to everyone who's joining us today from Singapore. I'd like to preface all my remarks today in this session by saying that I think all of us could use a good dose of humility. I think what COVID has done last year is it has exponentially raised the unpredictability of markets. And I think that's something that's going to continue with us in 2021. I don't see 2021 as post-COVID. I see it as a transition year. I see it as a world learning to live with COVID. So again, within that, there's going to be a huge diversity. There's going to be countries which race ahead with the immunization, mostly the developed world. A lot of countries in emerging markets and poorer nations simply learning to live with COVID, because as we all know, immunization is not going to reach them perhaps until the end of this year. I would probably see 2022 being an optimist here, I think, as a post-COVID world. So I think that sort of sets the framework for the way I approach oil markets and the supply-demand balances and prices. Now, when I said earlier, the exponential rise of unpredictability, look, the actors and the factors in the market remain more or less the same. We are all going to be looking this year at supply, demand, and geopolitics, as Peter alluded to it. I fully agree with him. I think geopolitics is going to be quite a wild card this year. But to me, it seems like the script writer has changed almost midway through the series. So huge unpredictability. Now, demand, of course, is going to depend a lot on how well the immunization proceeds in the Western Hemisphere. I think in Asia, as I mentioned earlier, a lot of the countries are just learning to live with COVID. So far, the way we've looked at Asia is that there's been no major, at least no frightening major second waves. More or less countries, especially the big demand centers of China and India, are well on the recovery trajectory. But again, I think I would be very, very cautious here in assuming that trajectory is going to continue smoothly. So I think a word of caution there is important. As far as demand, as far as supply is concerned, I think we had quite a degree of certainty last year after the March OPEC non-OPEC collapse. I think that might be on the rocks this year as well, and happy to talk a little more about that. So we have demand uncertainty, and now adding to it supply uncertainty as well. So basically, I feel the market is going to keep us on our toes very much throughout this year as well.
Great. That's a great jumping off point, this idea of supply uncertainty. I mean, it's kind of challenges the conventional wisdom to think that there was some bit of certainty last year. But I suppose, yeah, if you do look at it, OPEC was very clear about their cuts. They did maintain the disciplines that did give us some bit of certainty. And I would agree that, yeah, going into this year, there are still a lot more factors that are opened up. So just as you mentioned there, Vandana, that everything is going to be unpredictable, I think now we're going to ask you to make some predictions about the new year and about that uncertainty. And I wanted to talk specifically with you about that OPEC dynamic going into this year. Because I think that the most recent thing, and one of the things we're all thinking about, is the OPEC cuts, how they're going to phase those out. We've got an additional 500,000 barrels in the market this month. They decided to stand pat on those quotas for February and March, except for the Saudis, who are coming in with a huge shock 1 million barrel a day cut. So tell us a little bit about how the dynamics in OPEC are going to work as we go through these next 2.5 months now to get to April. What needs to happen in the market for us to be ready for the Saudis to put that 1 million barrels back in the market and for the market to be able to take it without cratering prices? And again, as the Saudis are coming back in with that 1 million barrels a day, how do they manage that with the other members who, of course, will also want to be bringing their oil back in?
Yeah, so the dynamic within OPEC, non-OPEC was always quite diverse. Let's just face that, which was a reason for that major debacle last March and a virtual breakup of the group. They did pull together remarkably well and with unprecedented 10 million barrels per day of cuts. But I think it's good for us to acknowledge and bear in mind going forward. Let's just look at the huge diversity between the de facto leaders, Russia, the de facto leader of the non-OPEC allies, and Saudi Arabia, the OPEC leader. Russia needs about $57 per barrel price to balance its budget. Saudi Arabia needs 89, those are the reliable figures that I have. So, these two countries, while they are doing their best to pull together, in recognition that either they do it or, everybody suffers, including these two nations. So that has kept them together. But I think that diversity within the group, the very different economic fortunes, the varying dependable reliance on oil revenues may start becoming a major strain. You mentioned what might Saudi Arabia do in April, and I think that's a very, very interesting point. Something the market is not quite looking at right now because we are still, as a marketplace and market watcher, still recovering from the bombshell that Saudi Arabia dropped on the market last week. And this goes back to my point where I said that, the sort of certainty we had come to assume on the part of OPEC, non-OPEC last year is also, we should not assume it this year. That's a case in point. But let's look at this. Come April, obviously, Saudi Arabia has to decide, but Saudi Arabia needs to make that decision at the beginning of March before it comes out with its official selling prices for April and before it does the allocations for April. Now, at that point, if it's lucky, we will have a market that is looking much stronger, looking at summer demand. Inventories have drawn down quite a bit, and all of that would be a reasonably good stage for Saudi Arabia to bring back the 1 million barrels per day. However, if that doesn't happen, the kingdom might find that it has a tiger by the tail. And also, let us not forget that the other OPEC, non-OPEC allies, at the same time in March, will also potentially be bringing back a 1 million barrels per day, because let's remember that they had looked forward to bringing up to 500,000 barrels per day every single month, but they are holding their peace over February and March. So here we are at the start of March, and you could have a Saudi Arabia potentially looking to bring the 1 million barrels per day back into the market, and the rest of, and OPEC, non-OPEC collectively potentially looking to bring another 1 million barrels per day back into the market. So the big question for the market is not going to be about the 1 million that Saudi has removed, but can the market in Q2 accommodate 2 million barrels per day of additional supply potentially? So I think Saudi Arabia will have to be very careful. Obviously, it will not want to give up any of the advantage that it has gained as a result of the surprise move. It might choose to taper, bring back that 1 million barrels per day slowly, but watch out for rising tensions within the group. Basically the 1 million barrels per day potential extra from OPEC plus versus the 1 million barrels per day that Saudi will want to bring back could mean a lot of additional tension.
Yeah. That's an interesting view there. Kind of putting it in the perspective of that 1 million barrels potential from the other OPEC group of OPEC plus members. Of course, we don't know what OPEC plus is going to decide about that return of production, whether they would want to keep it in that kind of phased approach of 500,000 and just kind of delay the plan, or whether they would try to go 2 months all in one there. And that's a good point from you as well, that we would need to know in the beginning of March. The indication from the Saudis is that this is a one and done deal. They'll cut for those 2 months, unwind that, and they're not gonna do that again. So a signal to the market not to expect Saudi to continue doing the heavy lifting, but we'll have to see, what is the other lifting that the other OPEC members want to do. Before we get to our next question for the panelists, let's bring up a question, the survey question. We've got 2 survey questions that you can see right there that we'll put to you through the session, so you can go ahead and look at those and vote on your screen. This is the perennial question. We want to know where our oil price is headed this year. Is it going to be a 45 to 55 barrel average, which is pretty much the where we were yesterday, last year, excuse me, kind of the high end. 55.65, that would show some upside for this year. Will that be the average this year? Will oil peak above 60 perhaps and then drop back? Or a negative view? Will it be lower than 45 on average this year? So go ahead and vote on your screen, and then we will have some time to compile those, and we'll come back after our next question. So go ahead and put your votes in for that. Great, and then we'll pick up that answer shortly. So let me jump on to, let's not do the second question yet. Let's wait for that. We'll jump on to our next panelist, because I wanted to ask a question to Kevin in terms of those, the oil supply. Vandana was just kind of laying out some of those uncertainties we have about the supply going forward. But Kevin, I wanted to know from your point of view, from what you're looking at, the tankers and the cargoes, what are we seeing in terms of crude flows into Asia, be it from the Middle East, from the Americas, from Russia? And can we read anything into competition for market share from that? Because we're hearing, a lot of people saying that OPEC can't continue to continually cut. They're going to erode their market share. Are we seeing that really come into play in the product flows, in the crude flows, excuse me?
In the crude flows, yes, certainly. One of the big diversifications we saw last year, was obviously, or over the last couple of years, was into the shale supply, shale oil coming into China in particular. And I think, I was looking at our own stats just before we came on air and looking at the sources of crude that are popping up for January, February, March into China in particular. And we've got, the North Sea is on there. We've got South American grades on there. We've got West African grades on there. We've obviously got a huge raft of Saudi, Iraqi, Kuwaiti, Abu Dhabi grades, etc. But what this all tells you is that supply of crude going into China has really been diversified over the last couple of years, so that it prevents really the impact of a supply shock. So if we get, as Vandana said, the sort of, I'm not going to call it consensus, but the creative tension within OPEC and OPEC Plus, if that suddenly creates a situation of reduced supply within the market, then the Chinese have got plenty of places that they can go to for crude. And we've seen that. So this is not, this is not unprecedented at all. This is something that's been established over the last few years, and I think will continue. I think one of the other things that we're seeing at the moment is that despite a slight dip at the end of the year into December on crude imports, it was actually about, according to our data, about the lowest level in the last 18 or so months of crude import into China. But we're actually seeing a strong recovery going into January of this year. And I think what we're going to see is a continuation of that, i.e. the Chinese refining system is going to run hard. We're going to see Chinese demand outstripping, certainly for products, outstripping any other nation within the region and probably any other nation around the world. And the Chinese refining system will need to run in order to satisfy that demand. Now, over the last couple of months, we've actually seen a drop in exports of middle distillates in particular. And that's for a couple of reasons. One is, we've seen seasonal demand. As we've all mentioned, it's been cold over the last few months. But also, the wider market, the wider regional and global market has really not called for huge increases in supply of middle distillates. And so the Chinese, Korean, and Japanese, and also Taiwanese level of diesel exports has dropped off. But I think, as we go through the year, we get into some sort of recovery and demand. Again, Vandana makes the point about this not being a post-COVID year. It's not at all. It's a transition year. It's the step between where we were and where we're going to, which isn't nearly as profound as it probably sounds. But the point I'm making here is that, an awful lot of our predictions here require recoveries and normalization in demand in particular. And I think it's hard to see that happening, whilst we've still got a significant number of cases around the world and around the region.
Kevin, is that diversification of supply into China, is that something that's going to weigh on OPEC as they talk about how long they should continue these cuts? Or is that something that we should just see as a natural course of the diversification of the oil markets? I mean, is this market share going to come back to OPEC, or are we just going to see continued greater competition?
I sat and listened to an interview between Sean Evers over at Gulf Intelligence and Mark Moody-Stewart from Shell, so in the third quarter of last year, and he was talking about the remarkable situation within the oil market, that the most efficient and cheapest producer is actually the swing producer, is OPEC. And it's a situation that doesn't exist in other commodities, that doesn't exist in other markets. OPEC should have the market share that it almost sort of dictates. I mean, obviously we've got other suppliers. OPEC should be able to.
Kevin, I think we're losing Kevin a little bit there. Kevin, can you hear?
I would make the point as well that we look as a company. Kpler looks quite closely at obviously output from the OPEC and the non-OPEC countries. And one of the interesting sort of behavioural patterns that we saw last year was the level of compliance. Because as we got into the initial sort of cut stage, April, May, June, a lot of those countries actually struggled to maintain the production cuts that they promised to the group. And as we got through the third quarter, Iraq, Nigeria, and others who've been really laggards in terms of obeying their own or living up to their own production cut promises started to really comply, and we saw a difference in that kind of behavior. And I think that is also kind of interesting because it says to me that there is much more discipline around maintaining cuts, and therefore there's much more cohesion within that creative tension of the OPEC group. So I think, we will see, OPEC became very, very aware, I think over the course of last year in particular, of how quickly the market responds to oversupply and how hurt they are as petro economies. And I think we're going to see a level of discipline within OPEC and OPEC Plus because of the fear of cratering the market and hurting their own revenues. And I think that ultimately is going to be a hallmark of certainly over the first half of this year and where we get to in terms of supply.
Yeah, okay, that makes sense from an economic standpoint. The lowest cost producer should have most of that market share, should probably be the last man standing as we come, in the next decade or so, even to peak oil, peak demand situation. Is that kind of certainty going to ease minds in OPEC countries, or are there still going to be some very nervous people? So as the prices now still aren't at OPEC break-even levels, and according to a lot of the estimates, aren't going to be for the next couple of years. Not in a useful time frame for these countries to adjust their budget. Victor, I wanted to turn to you. Kevin had mentioned something quite interesting that I wanted to ask you about as well. Is this fewer distillate exports from China? Obviously, the demand in China has been one of the big stories of last year as it kind of roared back and helped bring prices back from this, along with those OPEC cuts. China's a huge market. Obviously, there's a lot of domestic demand there, but they're also exporting product. Are they kind of sucking the air out of that region in terms of discouraging demand in some of the other countries because there are how sustainable as well is this Chinese demand? We've seen prices coming up. The differentials on the latest round of OSPs have come up again, and we understand that some of the Asian refiners in general, felt a little bit hard done by the level of OSPs last year. They thought it was quite healthy in terms of the price level. So how sustainable is that demand in China going forward, and what's the dynamic we're going to see?
Well, I would say this would be quite stable in the coming few years. Well, as we know, last year, China's imports were surged by about 9.5%, close to 10%, to about 11 million barrels per day. And this was largely due to crashing price as well since March and late February and March. So about over 500 million barrels of crude actually went to storage last year, not because of actual demand, from the country in that year. So we need to take this into consideration when we look at the country's imports in 2021. So almost all the storage were filled, for some time of the year, 2020. And in 2021, we had 2 more refineries were on stream. One is 200 million barrel per day CDU in November 2020, and another one with the same capacity is coming on stream early this year. So altogether, it's about 400,000 barrels per day, new for 2021. And another refinery, also private one, 350,000 barrels per day in the last quarter of this year. So we consider this new capacity and the crude storage, the crude that went into storage last year because of low crude prices. And meanwhile, we need to consider much faster economic growth, for 2021. Say, a lot of organizations will forecast about 8%, at least 60.9% of GDP growth for 2021. So we need to balance this one. And so we believe the imports will grow fast, still continue to grow fast in 2021. But I wouldn't be surprised if the growth slows down a little bit from 2020 because of the price as well. When prices crash, refineries just try their best to build up the stockpile as well. And even if they were not consuming that much soon, but in 2021, if prices are behind, above $50, so they would need to consider this, balance this actual demand and their imports, despite the 20% increase in their quotas for 2021.
Yeah. That's an interesting dynamic there. I guess the additional capacity would be a benefit for crude demand and for the imports, but this crude in storage will kind of take a little bit of the edge off that
Yes,
potential
yes.
increase. So kind of feed into those new refineries. Of course, when we do have that new capacity, the flip side of that is that there's a lot more product out there. There's a lot more supply.
Yes.
Where does all that supply of refined products go, and how then does that feed into prices and refinery margins, which feeds back into the demand. So since we are on that point there of kind of prices and crude prices, let's look at our survey result and see what you guys all voted in terms of crude. Let me have a look at there. Okay, so the overwhelming result is for 55 to 65 barrel a day average. So on Brent, that's where we are now. It looks like you're all looking for some more upside in prices this year, I suppose, on the strength of the vaccines. No one is negative. No one is saying lower than 45. And yeah, we've got peaking at 60 and then dropping back. That's consistent with our 55 to 65 average. So we're all optimists this morning, it looks like. Let's get the second question, the second survey question put up there. You can vote on that, and then we'll have an answer for that after we hear from Peter. So this question is getting back to what we talked about earlier, the Saudi cuts. A lot of analysts have been saying that the Saudi cuts, because Saudi Arabia is doing that heavy lifting, that will encourage some cheating by some other producers in OPEC as they try to gain from the higher prices. So will Saudi Arabia's unilateral production cut spur quota cheating among other members? Yes, more than usual, since we do see some quota slippage all the time. or no, it will be the same as usual in terms of compliance. So go ahead and have a vote on that. We will compile those results and we'll come back to that. But I was hoping now, Peter, that you'd be able to kind of give us the view of what's the context in which we're going to be talking about all these oil market issues, particularly regarding the new administration coming into the U.S. I mean, what is a Biden policy going to be that's going to affect those factors that impact oil? I mean, the immediate impact that we might be looking at would be sanctions or sanctions relief on either Iran or Venezuela, or the impact on supply from any environmental policies. But I also want to know how you see things like the dollar and this kind of new year commodities spurt that we've seen kind of across the commodities complex, how you see those factors playing into it as well.
Well, I think we'll start with the last ones first, Anthony, and then we'll work backwards. I still believe that the super cycle, due to the stimulus that's been a global push forward, and putting it mildly, has been unprecedented. And what we're going to experience over the next decade is going to be, I think, a super cycle of building, of movement, of you name it. Nearly every commodity, I think, is going to be bid up. So from a demand picture, as far as price is concerned, I think the overall, where we've got to be mindful over the last, say, 9 months, we've seen that US dollar index peak at 103, 104 nearly, now at 90, was at 89 odd last week, and it's bounced a little bit, that US dollar index. So I think let's see what happens as far as the administration moving and coming into, the latter part of next week, whether it bounces to the upside. So whilst we've seen crude prices have a big push up, we're also mindful of that US dollar capitulating. We're now seeing bond yields starting that 10-year. We're seeing, are we bouncing from the bottom? It's been a commodity and been a currency trader's delight over the last 6 months or 8 months, and including equities. So I look at the big picture. It's a little bit uncertain where that US dollar trades. I know higher energy prices push inflation up, which in turn creates a bit of not a good picture for central banks. And then where are we? I'm seeing the rhetoric coming out of your Secretary of State, Mike Pompeo, regarding Iran. That's I haven't seen him as vocal on that for quite a long time. And whether we're going to see something happen in the last matter of days as far as this current administration. I'm also looking at the lens that I look at as north and north only, considering I live in Sydney, and that north leads me straight into China. It leads me into a prime minister that's just received a medal from President Trump as far as leadership. I'm looking at the situation in Taiwan, and that's really, I think, could cause a great degree of concern to that whole sector. So that creates uncertainty again, and they're the unknowns. I did preface when you first introduced me, I said, I think there's some unknown unknowns, and that's what, from a trading perspective, I've got to be across. I just can't be across seasonality, demand, or technical analysis. I've got to look at the big picture and see all those moving parts and what impact they have to markets. And I'm looking at it holistically, but I'm also challenged. I listen to Victor, I listen to Kevin, I listen to Vandana. I take all of that knowledge on board, and I still believe there's a little bit of upside, but I'm not sure how much further. And how the rest of these 50 weeks play out, the book hasn't been written. Anyone or anything can happen. And I think this year is going to be full of surprises.
Yeah, for sure. Well, we have seen some surprises so far this year, but I suppose if you look at it, these are kind of the same old things that keep happening. We've seen these Iran tensions ratcheting up in the Gulf. I suppose we can expect to see some continued additional tensions in China. So I suppose, as you say, when you're trying to be across these issues, it's where do you expect the unknowns to come up is almost what we can be looking for this year in this unpredictability. We've got one question that's come in from the audience, which I wanted to throw out there. And then you can think about that while we look at our survey results. But first, here's that question from the audience. Where does the panel see HSFO demand in 2021 in Asia? So high sulfur fuel oil, where do you see that? Have a think about that while we look at the poll results. Yeah, we see people cheating more than usual in OPEC. So as we see prices, I think Brent was about 57 this morning when I last looked. So is that going to induce some people to put a few more barrels on the market? Yes, that's the expectation. You know, 2/3 to 1/3 yeses to nos. So I suppose that's quite normal. So we will see how that plays out, and if it does increase beyond that expected level, you know, how does that weigh on the cohesion in OPEC? So in terms of high sulfur fuel oil demand in Asia, maybe Victor or Kevin or one of you guys wants to jump in on that one. What are you saying?
Sure. Sitting here in Singapore, the world's largest bunkering port, it's certainly a consideration for the market here. It's a very interesting one, simply because I think, you know, 2020 was supposed to be the year of LSFO versus HSFO spread blowing out. We were supposed to see a huge increase, you know, in that differential, and therefore we were going to see an awful lot of incentive for people to fit scrubbers in order to take advantage of low HSFO prices. That spread didn't really eventuate. We didn't see, you know, the numbers that were predicted on forward curves or in terms of actual trades, and as a result, the number of scrubbers fitted was relatively modest. Now I know as we go through this year, there will still be some vessels that will fit scrubbers, which will add to HSFO demand. But I think ultimately, HSFO demand is going to be slightly disappointing versus where probably people expected it to be. I think the idea was, or the expectation was that scrubbers would really take up the surplus of HSFO, and because the spread between HSFO and LSFO hasn't been there, ship owners have basically said, well, I'll just buy low sulfur fuel oil and save the cost on and save the hassle of fitting a scrubber. So I'm not massively bullish for HSFO demand, just basis the fact that, or basis where I was probably expecting it to be in 2019. But that's just really, as I say, as a result of limited scrubber uptake in 2020.
Yeah. Okay. Great. Yeah, that was one of the big kind of the known issues that we had going into 2020, which as you say, really didn't kind of shape up to be what it was expected. So guys, we are up to time, and because we're on a 12-hour global forum today, we're really keeping to the time schedule. So I'm sorry to say that we're out of time, because we had a lot of great thoughts here, and I think there's a lot that we could have continued discussing. But you know, let's keep up the conversation with each other, with the audience. And I think there will be some additional opportunities for discussion throughout the forum today. So I want to thank all our panelists, Vandana, Victor, Kevin, and Peter. Thank you all for your great insights. And for me, it was certainly thought-provoking on several fronts. So I wish you a good rest of the forum, a happy new year, and all the best. Thank you.
You too.
Thanks very much.
Thank you.
Thank you.
Bye-bye.
Thanks, Peter. Thanks, Victor.
Thank you.
Appreciate the comments.